Gift tax is not income tax, it's a transfer tax. It can apply when one person transfers property to another for less than full value. And here's the exam trap. It can be a gift, even if the donor didn't mean it as a gift. If value leaves the donor's hands and the donor doesn't get equal value back, you should at least think possible gift tax issue. Gift tax and estate tax are tied together. Think of them as one system with two timing options. Gifts are transfers during life. Estate tax is transfers at death. They share the same lifetime exemption concept, so gifts you make during life can reduce what's left available at death. On the EA exam, they love asking you to identify which tax regime you're in, alive versus deceased. Who pays the gift tax? The donor, not the donee. That's a huge exam favorite because it feels backwards to people. The recipient typically doesn't owe tax just for receiving a gift and usually doesn't report it. One common exception you'll see elsewhere: certain foreign gifts can trigger reporting by the recipient. But for core gift tax, the liability sits with the person making the transfer. Now, the cleanest exception: direct payments for tuition or medical expenses. If you pay someone's tuition directly to the school, that's not a taxable gift. Same idea for medical expenses paid directly to the provider. The key word is directly. If you give cash to your niece and she pays the college, that's not this exception. On the exam, watch who receives the payment. Two more exam-friendly details on that direct pay exclusion. First, there's no dollar limit for this exclusion if it's paid directly to the institution. Second, there's no gift tax reporting requirement for that payment, regardless of amount. So, if you see a huge tuition bill paid straight to the university, don't panic about gift tax. Just confirm it wasn't reimbursed to the student. Quick mental checklist for, is this a gift? Ask, did property or value move to someone else? Did the donor receive full consideration back? If not, it's potentially a gift, even without intent. Then ask, does an exception apply, like direct tuition or medical payments? This approach keeps you from overthinking the fact pattern, which is exactly what the EA exam wants. Before her death on January 1st, Natalie owned a custom bridal dressmaking shop and used the cash method. At death, she was owed $20,000 for a dress. The vendor paid the $20,000 on March 1st, after her death, and made the check to the estate. The sole beneficiary is her son, Ethan, but the money wasn't distributed before the estate settlement. Where is the $20,000 reported as taxable income? Think about it. The correct answer is the estate's income tax return, Form 1041. This is income in respect of a decedent, or IRD, earned before death, received after death. IRD is taxed to whoever actually receives it. Here, the estate received the check and didn't distribute it, so the estate reports it. The tempting wrong choice is Natalie's final Form 1040, but cash method income not received before death doesn't go there. Derek earns $35,000 in wages. His wealthy aunt dies, and he's a beneficiary of her estate. Later in the year, the estate attorney sends Derek a $9,000 check and a Schedule K-1 from the estate. Where should Derek report this income on his personal return? The options include Schedule E, Schedule C, no tax at all, or Schedule D. Think about it. The correct answer is Schedule E on Derek's Form 1040, using the information from the Schedule K through 1, Form 1041. Beneficiaries generally report pass-through income from estates and trusts on Schedule E, keeping the characters shown on the K1. A tempting wrong answer is Schedule C, but Derek isn't operating the estate's business himself. He's receiving beneficiary income reported to him on a K1.